Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I'll be your host for the next 25 minutes here on Options Guide TV. Earnings season is upon us, and we have almost all of the Mag 7s announcing, the Mag 7 companies announcing stocks this Wednesday. On Wednesday, we have Microsoft, Amazon, Meta, Alphabet, all announcing after the close on Wednesday. And then just, for sake, we have Ford that is also announcing, Qualcomm. Wednesday is going to be a huge day as far as earnings is concerned. And then we come to Thursday and we have Apple, Eli Lilly, MasterCard. Tomorrow we got Visa. And that's going to be a real interesting one on Visa. I thought about looking at a trade in Visa, but I'm not quite sure where to go. I feel like I'm a little bit more just neutral in general on the credit card companies. But it'll be interesting to hear what they say about the consumer. The consumer is saying consumer sentiment is extremely low, but look at what they do as opposed to what they say. And that, to me, is going to be the case with Visa and Microsoft. See if the consumer is still staying strong. What are the delinquencies at? And so little bit, I don't know if I really have a position going into earnings, because I do think earnings will be strong, but I do worry about what they're going to say about the consumer. All right, so we're going to look at Amazon. Now, Amazon is, a hybrid. We have Amazon. You could even make an argument that if it's a low cost leader driving prices down, if we are in a stagflationary economy, which a few people have said, I guess it's kind of waned a little bit in those comments, but Amazon is a stock that it has made investment in AI that's in the middle of that space. AWS is a very strong part of their company. And so I decided I'm going to do our open wing butterfly on Amazon. Now, we're going to have a chance to trade out of that because we'll be back on Wednesday at 11 a.m. Eastern time, time to make the donuts, 11 a.m. Eastern time on Wednesday. And we will be able to look at the Amazon trade and make an adjustment if we would like. But at this point in time, we're going to start by setting up our open wing butterfly in Amazon. All right, so trying to keep it under $4. I want to give myself a little bit of upside. Let's run to the Tradio Pro software and let's pull up the Amazon trade. And want to let you know we've changed things up a little bit. So if you hear a little ding in the background, that's probably not your iPhone. But if you do actually make a comment and we're going to actually address it during the show, we're actually going to highlight that with a little ding. And so you will know that we will answer any questions that you have. We want to make this as interactive as possible. So please let us know if you have any questions on any of these trades. Some of them are advanced. I don't mind explaining them 2 or 3 different ways if you would like. But around earnings season, we almost always like to focus on stocks that we don't mind doing butterflies on and try to decide if we want to get bullish or bearish on them. Butterflies are a real interesting trade around earnings because you have the very short-term expirations, especially nowadays, even in Amazon. Like, we have an expiration date on the day that they're going to announce earnings, which is April 29th. And then we have the Friday expiration, normal Friday expiration, which is May 4th. So there are the daily expirations are filtering in to some of the most popular stocks in the marketplace. And so now you have a whole bunch of different earnings. And when you have these different a whole bunch of different expirations going around these big stocks that are announcing earnings, volatility comes up. They're fairly expensive stocks, like Amazon, $262 stock at this point in time. And you can really play with the dynamics of an options price. And that is what a butterfly is to me. If you're correct on your forecast, you want implied volatility to come down. You want time premium to go away. You have the ability on a 1/2/1 basis, which is the ratio to sell an option contract that if the market starts going towards it, you want that time decay to happen. And that always is what attracts me to different butterflies. So we change up the butterfly. I call this an open wing butterfly. We open up the wing, we give profitability to the upside, and our only risk will then be to the downside. Now, to me, it's an alternative to a long call spread. The open wing butterfly is, because on a long call spread, you just want the market to go up and you hope that it finishes above your short strike. And we're okay with that with the open wing butterfly, but we get to sell 2 of those option contracts instead of just 1 on the long butterfly, which means that, or on the long spread, which means that we have less overall risk. Okay, so let's set up the Amazon trade. Amazon's at $262. Wow, it's hard to say. Here we go. Amazon is at $262.62. It is down $1.38. We're going to use the Friday expiration. They're going to announce on a Wednesday. So you got all day Thursday, all day Friday after that earnings report, before these option contracts will expire. We're putting it on today on Monday, and today it's Monday, April 27th. So you will have a couple of days that this trade will play out before the announcement happens on Wednesday. So we might actually make an adjustment on Wednesday morning. But we're going to look to buy something very close to where the stock is at. We're going to buy the 265 strike call. We're then going to go up 15 points and sell 2 of the 280 strike calls. And then we're going to go 7.5 points, half of the width of the long butterfly. And we're going to buy the $287.50 strike call, $287.50. Now, by doing that, I like to say I'm stopping short on the short spread. A butterfly is made up of a long spread and a short spread. And by stopping short, we don't bring in as much of a net credit, but it opens up the range of where we can be profitable. And this trade right now is trading, interesting, $3.66. A lot of 66 is going on. $3.66 at this point in time. That means for every 1x2x1 open wing butterfly that we do, we have $366 plus any commissions as exposure on that trade. Let's send this to the what if calculator and let's take a peek at what our upside is if Amazon announces earnings and the stock blows through all the strikes to the upside. We know on the downside, if we are incorrect on our forecasts and the market perceives the earnings report as a bad earnings report, or they just decide to sell it off because of the earnings report, anywhere below the lowest strike, which is the 265 strike call, this butterfly would go out worthless, and the maximum we could lose is that $3.66 or $366 per 1x2x1 butterfly that we execute. All right, so on the upside, here is the profit and loss calculator. We see no good from 265 on down. If the market starts drifting higher, our maximum upside is right at our middle strike. And if we do get to that strike price, this thing can trade as high as $15. That means we would be up 1,000. Well, based off of I think it pulled, let's see what it pulled, 366. All right, the exact price that we paid for it. So right at 280, we would be up $1,133.55 if we landed right at 280, right at expiration. If the stock drifts higher and we go above our $287.50 strike, 287.50, from that point on up, we would be up $384 from that point on. So if we get an expected move to the upside, about what the expected move is, the maximum we could make on this trade, or the maximum the butterfly could trade for, let's say it that way, would be $15. And that would take it to land right at the 280 mark. So we'd like it to land somewhere around there. Thinking that it might land exactly on 280 is pretty tough, but we're okay if it's higher. So if we drift higher, you can always come back and land, but we're profitable anywhere above 280. And we're quite profitable. As a matter of fact, we're at least can double our position if we land anywhere above the $287.50 strike. So I like the setup. I like it going into earnings. We're going to put it on today and maybe make an adjustment if we need to. We got a couple of days after the trading. One of the things that will be tough is that if they announce on a Wednesday, there's all day Thursday and all day Friday. So there will still be a lot of time premium and probably quite a bit of volatility in the option contracts on Thursday before it really starts releasing. Usually you start to see the huge rate of time decay in the afternoon on the last day of the life of the option contract. So Friday at noon Eastern time is when it really starts to build. And short-term trade obviously need Amazon earnings to be perceived as good. I always say perceived as good because sometimes you can have good earnings and the stock will sell off. They'll look at it as that opportunity. But if we go look at the chart on Amazon, and actually Coca-Cola is announcing tomorrow morning too. But if we look at the chart, we see that we had a fairly strong breakout. We've had a solid chart recently, but this was a breakout from a new high, and it was able to establish that new recent high right here, 257.21, and now we're at 262.88. I think we're going to have some solid momentum going into earnings, but you can see gap openings are not new for Amazon, so there will be risk if it gaps to the downside. It will be hard to capture much of the $366 that we're paying for our 1x2x1 butterfly. All right. Now, if we have any questions, do put them in the chat box and I will try to address them during the show. Let's go over to our portfolio. And we added a couple of positions. We looked at the Tesla trade, and on the Tesla trade, right now, the midpoint on the option contracts isn't looking that great. I did put this position on, and I went out to the May 5th expiration. We talked about the Friday expiration on the show. So we do need a strong move back on Tesla in order for this to really pan out. I don't think I would close it at this point in time. 39 cents on our longest option contract and 17 cents on our cheapest option contract. Now, if there's some premium in these options, sometimes I don't mind looking at a roll in the position. You sell the most expensive one and buy the least expensive one, and you try to capture some gain. Here it's only 20 cents. It's kind of ran away from us a little bit. But that's my position. Like, so if you do go a little bit longer and there is some premium that's in on that position, you can go from being bullish on the trade to bearish, and you can do it fairly simply and take a little bit of money off the table. So let's look at that trade in Tesla. And let's go to the options grid, and we're going to go to the May 1st expiration. And here's our trade. We're buying, we're all the way up here, aren't we? TSLA. We have the 410 strike, 425 strike, 435 strike. So I want to talk about the adjustment, and it may be feasible on Amazon if the market was down. You got 2 full days, fairly expensive because it's got to restore, it's got to hold on to that premium. But Tesla, to me, was very annoying, and I may have mentioned this on the last show, but usually Tesla will go down and then Elon Musk will come out and start talking and the stock will start going up because he'll make absorbent forecasts as to where Tesla is going. This time around, he came out and mentioned more CapEx spending, and that is the naughty phrase in the market right now. At one point in time, it was praised CapEx spending. Now everybody's like, "Oh, wait a little bit." But once he mentioned the numbers of the CapEx spending, the stock actually has been beaten up ever since. So the trade is you would sell the most expensive option and buy the least expensive option, bringing in a net credit to the account. And then you would be short 2 of the 425, 435 short call spreads. Now, if you would have did the short call spread to start with, you would have been profitable. But this is just flipping the script and saying that we don't think it will come all the way back to the 425 level. But there's just not enough premium in it to do that at this point in time. But that would be an adjustment that we would consider in Amazon. Now, on Netflix, we did our roll and we took some profits. We're down about 50% on our Netflix option that we rolled heading into their earnings. And with the 90 delta or the 90 strike call option, we see the midpoint of the stock at 92.80. Our rule is that if we hit that strike, we're going to get out of this option. So we have to hope that, and I'm going to keep hitting new core earnings. That's what's popping up. But if the hope is that we can rally from this point in time going forward, it'll need a little help from the market. The market right now is struggling. Headline news, geopolitical concerns once again. And Netflix is up about a quarter on the day today. But we got the SPX leaning to the downside. Might be an interesting day to actually just do a normal butterfly in the SPX, just one centered around where the market is at. But you obviously that's where I would lean to. I think the markets are just going to kind of stay flat today, try to figure out what exactly is going on over in the Middle East. All right. Our Netflix trade, let's look at Nucor is doing really well, up 72%. If the delta on our position is starting to get to 1, and we're very close. It's 195 here. We're up 72%. We have 52 days remaining. All right, let's look at the Nucor chart. I think it's time. Yep. Yeah, especially with this strong move to the upside. You're worried that we're going to give a little bit of it back. Let's take the profits and roll in Nucor. We have earnings coming out. When is it here? Okay, there it is. 427. Wow, so we have earnings tonight in Nucor? Yes, we do, after the close. We need to roll this. We do not want to give up this risk. So let's take this position on. And let's run over to the options grid. The expiration is June 18th. So I'll just sell to close this one. We're going to have to give up. Once again, we're in the paper trading app. So because of that, we're going to have to give up maybe more than we would have to in the real market. The market is at 55.90. It's not a horrible market for a very expensive option. Let's try 55 for a minute and see if we can get out of that. And then let's go search for an option that we can buy going into the earnings report. All right. Order has been sent. Nucor and UE. And we will go back out about $172 days. I think I like that one. September or October. We got a good choices here. I think we did a September option in Netflix. Yeah, 918. Let's use that one. Let's keep it simple. 918. And then we're just going to look for the 80 delta and look at open interest. Open interest is medium throughout. Here's the 80 delta. The 185 strike is 81. 39 by 37. 36 by 33. So we're right on the crust, in that we got an 81 delta here. We're going to have to pay a little bit more for it, but we do have the most open interest in that position. And then we got Okay, so let's do this one. $17. So we're not filled on our, so here's our order that we have. We're trying to sell the new core position, pull in $55. We'll call it 56 if we got it. We're going to get a little less than that. But if I'm doing this as a trade in my account, I would sell to close this one and buy to open the new option contract. I guess I could do it that way. I'll put the order in that way just so let's put that order in. Let's grab the options grid inside the portfolio. Let's go to new core. Let's click on this and let's hit roll and sell to close the 160. I'm going to make this one the 918. And we're going to go down to about the 145 strike. I think that was our trade. 145. And we have 2 contracts each. And we're going to buy 2 contracts. We don't need to go to the 145. We need to go to the 185. Yeah, why did I go backwards? That didn't even make sense. All right, here we go. Now, net credit. So we're going to take $17 off the table. $17.55 would be the midpoint, and I would work it fairly close to the midpoint. If I had this position on my account, I'm up about 75% on that option position. We're announcing earnings tonight. Delta is approaching 1. When it gets to 1, our rule is we want to take money off the table and roll again. And if we still like the underlying, we're going to roll out further in time. And I do still like Nucor here. So with this, we're going to enter this trade all as one trade. And this is the way I would do it in my regular account instead of legging out of it, because you have 2 fairly wide bid-ask spreads and you want to come down to the trading floor with something that allows them to manipulate the traders on the floors, and may possibly give you a little bit better fill on the trade. 1755 is where I would work it if it was in my real account, and then I would adjust from there. But I'm trying to get this filled during the show. We're going to go down and say a net credit of, let's say, $16. And see if we get that filled, and boom, the trade is sent to the trading floor, and we'll call that a day. That's it. Do we have any questions? If we don't, I didn't hear any bells going off today, so I appreciate you showing up. We'll be here on Wednesday for the next edition of Options Guide TV. We will adjust the Amazon trade if we need to, and we will see how our Nucor trade is doing after the earnings report tonight. All right, that's it for this edition of Options Guide TV. See you this Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.